The Fed's trillion-dollar secret, how they could unleash gold QE. Have you ever considered the possibility that the United States government is sitting on a hidden trillion-dollar asset, a financial power so immense it could be unleashed with a simple accounting change? This isn't a hypothetical scenario from a financial thriller. It's a potential reality embedded within the arcane balance sheets of the US Treasury and the Federal Reserve. It revolves around the oldest form of money known to man's, gold. While the world has been fixated on traditional quantitative easing, where central banks print money to buy bonds, a far more radical and potentially explosive idea is lurking in the shadows. A concept we might call gold quantitative easing. This isn't just an academic exercise. It's a mechanism that could fundamentally alter the financial landscape, and understanding it is crucial for anyone trying to navigate the turbulent economic waters ahead. The core of this issue lies in a monumental discrepancy between how the US government officially values its vast gold hoard and what that gold is actually worth on the open market. The United States Treasury officially holds over 8,100 metric tons of gold, one of the largest reserves on the planet. However, if you were to look at the government's official books, you would find this colossal treasure valued at a laughably minuscule figure, somewhere in the realm of 11 billion. This isn't a typo. This valuation is a historical relic, based on a statutory price set decades ago that has no connection to the modern, free-floating price of gold. It's an accounting fiction that has persisted for generations, a quiet footnote in the national accounts that most people, including many economists, have long ignored. Now let's contrast this official fantasy with market reality. With gold prices having experienced significant upward momentum, the actual market value of those 8,100 tons is not 11 billion. It is in fact approaching and at times has surpassed 1 trillion. This creates a staggering gap of nearly 990 billion between the recognized value and the true market value. This is not just an interesting piece of trivia. It represents a colossal amount of unrealized, off-balance sheet wealth. For a government grappling with soaring national debt and perpetual budget deficits, this trillion-dollar chasm represents an almost irresistible temptation. It's a pool of untapped financial power waiting to be monetized, a seemingly painless solution to immense fiscal problems. This situation presents what politicians and central planners might view as the ultimate opportunity. Imagine the discussions happening in the corridors of power. They see this enormous spread and recognize it as a potential windfall of epic proportions. The question they must be asking is how they can tap into this near-trillion-dollar asset without spooking markets or admitting to the long-term debasement of their own currency. How can they transform this inert, archaic asset into active, spendable funds? This is where the allure of financial engineering comes into play. They could, in theory, conjure nearly $1 trillion in new spending capacity out of thin air, all without the politically painful processes of raising taxes or issuing more debt to an already saturated market. The mechanism to unlock this value is both deceptively simple and profound in its implications. It centers on the unique relationship between the US Treasury and the Federal Reserve. Unlike in many other nations where the central bank holds the gold directly, in the United States, the Treasury owns the physical bullion. The Federal Reserve in turn holds gold certificates, which are claims on that gold on its balance sheet. These certificates are valued at the old statutory price. The Fed credits the Treasury's primary checking account, the Treasury General Account or TGA, with dollars in exchange for these certificates. This is the crucial link that allows for the magic to happen, a monetary sleight of hand that has been built into the system for decades. The catalyst for unleashing this financial force would be a formal revaluation of the nation's gold reserves. The Treasury would simply declare that it is abandoning the outdated statutory price and will henceforth value its gold at the current market price. This is not some wild, unprecedented conspiracy theory. Other major economies have done precisely this in recent history. Nations like Germany, Italy, and South Africa have all made the decision to revalue their gold reserves to align with market prices in past decades. This provides a clear international precedent, giving the US government political and economic cover to argue that such a move is merely a modernization of its accounting practices, a simple act of recognizing fair value. Once the gold is officially revalued, the subsequent steps would unfold with bureaucratic efficiency. The Federal Reserve would update the value of the gold certificates on its balance sheet from a mere 11 billion to the new market value of roughly 1 trillion. Simultaneously, the liability side of the Fed's ledger would expand. The Fed would credit the Treasury General account with the difference, a sum of approximately 990 billion. In an instant, the government's primary spending account would be flooded with nearly a trillion in new cash. This money would have been created not through the familiar process of bond buying QE, but through a direct monetization of a revalued physical asset. The tipping point for such a radical policy would likely be a severe economic or fiscal crisis. One could imagine a scenario where the US faces a sovereign debt crisis, with foreign and domestic investors becoming unwilling to absorb the sheer volume of new Treasury bonds required to fund government spending. In such a situation, the political pressure to find an alternative source of funding would be immense. Alternatively, a deep and prolonged recession could create a demand for massive stimulus programs, far beyond what could be funded through conventional means. In that moment of desperation, revaluing the nation's gold would be presented not as a radical debasement, but as a responsible and necessary step to ensure financial stability and economic recovery. The immediate impact of this action would be a dramatic expansion of both the Treasury's and the Federal Reserve's balance sheets. The government would suddenly have an extra $1 trillion at its disposal, ready to be deployed into the economy. This is where the consequences become critically important and highly uncertain. The inflationary impact of this new money would depend entirely on how it is spent. It represents a form of money creation that is far more direct and potent than traditional QE, which primarily inflates asset prices by creating bank reserves that often remain within the financial system. This new money would be injected directly into the real economy through government spending. If the government were to use this trillion-dollar windfall to fund programs like a universal basic income or another round of large-scale stimulus checks, the inflationary consequences could be severe. This would place a vast amount of new currency units directly into the hands of consumers, who have a high propensity to spend. Such a move would dramatically increase the money supply, chasing a relatively fixed amount of goods and services. Furthermore, it would likely increase the velocity of money, which is the speed at which money circulates through the economy. The combination of an expanded money supply and increased velocity is the classic textbook formula for a significant and potentially runaway inflation event. However, the inflationary outcome is not guaranteed and depends on the allocation of the funds. If, for instance, the government decided to use the newly created trillion to pay down existing national debt or to fund overseas conflicts and foreign aid, the domestic inflationary impact would be far more muted. In this scenario, the money would not directly enter the US consumer economy to bid up the prices of everyday goods and services. While it would still represent a massive expansion of the monetary base, its effect on consumer price inflation would be indirect and significantly delayed, if it materialized at all. This nuance is critical to understanding the potential range of outcomes from such an extraordinary policy. The effect on the price of gold itself is another complex question. One might intuitively assume that a government action validating gold as a core monetary asset at a value of 1 trillion would send its price into the stratosphere. However, the short-term impact might be less dramatic than expected. The act of revaluation is an accounting entry. It does not involve the government actively buying gold on the open market. Therefore, it doesn't create new demand in the same way that a central bank purchase program would. The price of gold in the short to medium term is often more sensitive to factors like real interest rates and perceptions of counterparty risk in the financial system than it is to the money supply alone. Over the long run, however, the revaluation would be profoundly bullish for gold. It would serve as an official admission by the world's most powerful government that gold is, in fact, a primary monetary asset of immense value. This would fundamentally alter perceptions and could trigger a wave of buying from other central banks, institutional investors, and crucially, the retail public. It would signal a significant loss of faith in the long-term value of fiat currency and could accelerate the ongoing trend of de-dollarization, as nations seek to diversify their reserves away from US Treasury bonds and into tangible assets like gold. The second-order effects of this shift in perception could ultimately be the most powerful driver of the gold price. It is also important to analyze the current dynamics of the gold market to understand the potential for future price movements. At present, the significant rise in gold prices has been largely driven by two main forces: aggressive buying from central banks around the world, particularly those in the East, and a surge of capital into gold-backed exchange-traded funds, or ETFs. These represent large, institutional-level flows. What has been conspicuously absent from this rally is the retail investor. In fact, data from precious metals dealers has indicated that the average individual investor has been a net seller of physical gold during this period, taking profits from previous purchases. This lack of retail participation is significant. Historically, the final, most explosive phase of a bull market in any asset class is marked by a wave of public hysteria and fear of missing out, often referred to as FOMO. We saw this in the gold market back in 2011 when retail buyers were lining up, paying high premiums for physical coins and bars. The fact that the opposite is happening now, with premiums on physical gold remaining low, suggests that this bull market may still have a long way to run. A policy as shocking as a massive gold revaluation by the US government could be the very catalyst that ignites that public frenzy, bringing a flood of retail money into the market and driving prices to previously unimaginable levels. Now we must peel back another layer of this complex financial onion to reveal a more profound truth, a concept that is arguably more important than the actions of any single central bank. The intense focus on the Federal Reserve and its policies, while understandable, often obscures the real engine of money creation in our modern economy. The true power to expand and contract the money supply on a day-to-day basis lies not with the central planners in Washington, but with the thousands of commercial banks that form the backbone of the financial system. This is a critical insight that is often missed by a majority of investors and financial commentators. When a commercial bank, whether it's a massive institution like J.P. Morgan or a small regional lender, makes a loan or purchases an asset from a non-bank entity, it fundamentally creates new money that did not exist before. For example, when a bank buys a treasury bond from a pension fund, it credits the pension fund's bank account with new digital dollars. The bank's assets increase by the value of the bond, and its liabilities increase by the amount of the newly created deposit. The total amount of money in the real economy has just expanded. This process is, in effect, a private sector form of quantitative easing that happens every single day, largely outside the direct control of the Federal Reserve. This mechanism is the bombshell that recontextualizes the entire discussion. While we debate the possibility of the Fed and Treasury creating $1 trillion by revaluing gold, we must recognize that the commercial banking system creates and destroys trillions of dollars through its regular lending and asset purchasing activities. The collective balance sheet of the commercial banking sector is a far more powerful determinant of the money supply and credit conditions in the real economy than the Federal Reserve's balance sheet alone. Therefore, a prudent investor should not only watch the Fed's weekly statements, but should be even more focused on the lending standards, risk appetite, and balance sheet expansion of the commercial banking system. Let's apply this understanding to our gold QE scenario. The process of the Fed creating $1 trillion on its balance sheet to fund the Treasury is functionally identical to a large commercial bank creating $1 trillion to buy a massive portfolio of assets from the non-bank public. In both cases, the money supply in the real economy expands, leading to more currency units chasing goods and services. The critical difference is that the gold QE event would be a single, highly visible and politically charged action, while the actions of commercial banks are diffuse, ongoing, and happen largely under the public's radar. The lesson for every investor is that the financial system is far more complex than the headlines suggest. The narrative that the Federal Reserve is the sole master of the monetary universe is a convenient simplification, but it is not the whole truth. The real story is one of a dynamic interplay between the central bank, the government's fiscal policies, and most importantly, the credit-creating power of the commercial banking system. The potential for a gold QE event is a stark reminder of the extraordinary and often unorthodox measures that governments can take when faced with a crisis. It highlights the inherent fragility of a fiat currency system and the enduring role of gold as a final arbiter of value. Therefore, as we look to the future, we must broaden our analytical framework. We need to monitor not just interest rate decisions and QE announcements from the Fed, but also the aggregate balance sheet of the commercial banking sector, loan creation data, and the risk appetite of financial institutions. These are the underlying currents that truly drive the monetary tides. The prospect of gold QE is not just a fascinating thought experiment. It is a powerful illustration of the hidden mechanisms that underpin our financial world. It serves as a warning that the rules of the game can be changed in an instant, and that the most significant risks and opportunities often lie in the places we are not looking. The revaluation of America's gold would not merely be an accounting adjustment. It would be a seismic event, signaling a paradigm shift in monetary policy and global finance. It would be an implicit admission that the decades-long experiment with pure fiat currency has reached its limits, and that governments are being forced to turn back to the oldest and most trusted form of money to shore up their credibility. Such an act would unleash a powerful wave of monetary inflation directly into the real economy, with consequences that would be felt in the price of everything from a loaf of bread to a barrel of oil. The purchasing power of the dollar would face a sudden and severe test. For the international community, this move would be a profound shock to the system. The United States, as the issuer of the world's primary reserve currency, would be seen as unilaterally altering the foundations of the global monetary order to solve its domestic fiscal problems. This could dramatically accelerate the move by nations like China, Russia, and others to reduce their reliance on the dollar and US Treasury bonds. These countries, which have been steadily accumulating gold reserves for years, would see the value of their holdings surge overnight. This would empower them financially and geopolitically, potentially leading to a more multipolar world where the dollar's dominance is seriously challenged. The impact on financial markets would be chaotic and unpredictable in the short term. While the injection of $1 trillion in liquidity might initially boost asset prices, the simultaneous shock to the credibility of the US dollar and its sovereign debt could trigger a crisis of confidence. We could see a sharp rise in interest rates on US government bonds, as investors demand a higher return to compensate for the increased risk of currency debasement. This would have cascading effects throughout the financial system, impacting everything from mortgage rates to corporate borrowing costs. The very foundation of the risk-free rate upon which all other asset prices are built would be called into question. The ultimate takeaway is that investors must prepare for a future where monetary and fiscal policies become increasingly unconventional. The line between central banking and government finance is becoming irrevocably blurred. The idea of gold QE, while seemingly radical today, fits logically into a world where governments are facing unprecedented levels of debt and are running out of traditional policy tools. It is a reminder that in times of crisis, policymakers will resort to measures that were previously considered unthinkable. The key to navigating this environment is to understand the fundamental mechanics of money creation, both public and private. We must move beyond the simplistic focus on the Federal Reserve and develop a more holistic view of the entire financial system. The true source of monetary inflation and financial instability often originates in the credit-creating activities of the commercial banking sector. By understanding this deeper reality, investors can better anticipate the true direction of the economy and position their portfolios accordingly. This involves looking beyond traditional stocks and bonds and considering the role of real assets like gold that cannot be created by a government decree or a bank's ledger entry. They offer a form of protection against the very counterparty and debasement risks that a policy like gold QE would bring to the forefront. The world is entering a new era of monetary experimentation. The comfortable assumptions of the past are being challenged, and the stability of the global financial system is being tested. The prospect of the US government revaluing its gold reserves is not a certainty, but it is a distinct possibility that encapsulates the immense pressures and temptations facing policymakers. It serves as a powerful symbol of the endgame for a debt-based fiat currency system. The prudent individual will not ignore this possibility, but will instead seek to understand its profound implications for their wealth, their future, and the very structure of the economic world we inhabit. The conversation about gold QE is a necessary one, because it forces us to confront uncomfortable truths about the nature of modern money and government finance. It reveals the arbitrary and often fragile foundations upon which our economic system is built. The idea that $1 trillion can be manifested by changing a number in an accounting ledger should be a sobering thought for anyone who believes in the long-term stability of the current system. It underscores the critical importance of holding assets that have intrinsic value and are not simultaneously someone else's liability. Gold has played this role for millennia, and its relevance may be about to enter a new and dramatic chapter. The political calculus behind such a move is as compelling as the economic one. For politicians, the ability to fund spending priorities without the immediate and unpopular consequences of raising taxes or cutting other programs is the ultimate prize. Gold QE offers a seemingly magical solution, a way to finance grand ambitions by monetizing a long-forgotten asset. It allows them to bypass the normal legislative and market constraints on government spending. The allure of this free money could prove too strong to resist, particularly in a moment of national crisis where decisive and large-scale action is demanded by the public. Ultimately, the story of gold QE is a story about trust. It is about the trust that citizens and investors place in their government's ability to manage its finances responsibly and to preserve the purchasing power of its currency. An act of overt monetary creation on this scale would be a severe blow to that trust. It would be a clear signal that the government is prioritizing short-term expediency over long-term stability. While it might solve an immediate fiscal problem, it would create a much larger and more intractable problem of confidence, both at home and abroad. The long-term consequences of this erosion of trust would be far more damaging than any short-term benefit gained. Therefore, the prudent path forward is one of vigilance and education. We must watch the actions of not only the Federal Reserve, but also the Treasury and the commercial banking system. We must understand the profound implications of policies that blur the line between monetary and fiscal authority. The possibility of gold QE serves as a powerful case study in the extreme measures that are now on the table. It is a reminder that in the world of modern finance, the unthinkable can quickly become the inevitable, and those who are prepared for this reality will be the ones who not only survive but thrive in the turbulent times ahead.